Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com, here with a Forex strategy video in which I want to address something that I've seen a lot of confusion about as of late. As it's heading into the end of the year, we've had some pretty consistent runs in multiple markets and multiple currency pairs. We start to see a lot of statistics arise. We see things like remarkable consecutive runs, higher highs, seasonality effect, and a number of other historical statistics which generate and lead themselves into meaningful observations of the market. However, a lot of people seem to think that this is the only thing we need as a measure for trade. Just like if we were looking at an individual technical indicator like an RSI, or we were just paying attention to one economic event risk like Friday's non-farm payrolls. We have to understand that this is not in itself a complete trade indication. We need to incorporate it into the bigger picture. All right. Now I want to look at some of these statistics. I've seen a number of them, and I've actually used a number of them recently, one of them being the S&P 500 and its seasonality effect for December, knowing it's the best performing month of the year typically, and volume is typically the lowest. All right. We know that this is an average over a historical period of time. Incorporating that into your trading, over the entire month you might see gains and certainly exceptionally low levels of volume. There's always the possibility of an outlier. All right, and, this might be one of those months where you actually, or one of those Decembers we actually see a really big drop on heavy volume because of a risk unwinding. All right, or it can be a pullback through the first half of the month before we actually see the second half of the month complete gains. All right, so you have to take it into perspective, and that's why you always want to look for confirmation through a fundamental catalyst, perhaps, whether we're talking about risk aversion, whether we're talking about taper speculation on the U.S. side, and you want to see the technical aspects. All right, so this is one common statistical theme that you'll see pop up often, and I will be using quite often. I just want you to put it into context, though. Another one that I've been using quite frequently, and we actually made an indicator for this, the consecutive bar index. All right, now this is just a measure of the consecutive bars, bullish or bearish, in either direction. Now this is actually a weekly chart of the German equity index, the DAX, and you can see that we've actually run 8 consecutive weeks to the upside. All right, we haven't seen a run of this magnitude since way back here in 1998. Now this is a great comparison tool. All right, it shows you an aspect of the market in a very quick glance that we wouldn't really be able to appreciate otherwise. Yet it doesn't necessarily mean that you're going to see a strong reversal from these highs that ushers you down to 7,500 or 5,000. That's projecting too much from this indicator. What it tells you, though, is it's exceptionally unusual to see a move of that consistency, a move of this measure, all right, of that stability. And a pullback would be highly likely. With each subsequent week that we add on to the tally, it's increasingly likely. All right, but as you would imagine, you can see continuation. Right. Now, a good representation of this particular instance and why it doesn't necessarily have to be a 1,000, 2,000 point decline, you see, you can just refer here to the last instance of this consistent advance, and you can see the pullback, while noteworthy, was not a 1,000 point or multi-thousand point decline. All right, so this is another measure, a great measure, and very useful. Seeing a measure like this as being oversold, you add on to it an RSI, which will probably give you a similar reading. You have a spark, like an ECB rate decision, or let's say German employment figures, or something along those lines, that can spur a turn in performance, and you have a more complete trade. But it's just one aspect of a more complete picture. Now, recently I've been looking at something a little bit more unique to the markets and a little bit more timely. We've seen a couple of things that have, as of late, turned their trend. I've been looking at the S&P 500, and we've seen this technical break. So we're approaching this from a different perspective. All right, we're looking at the technical aspects. We're seeing a tentative risk aversion move. I think that risk aversion aspect is far more important to a complete picture here, where you find actual momentum to the downside. But we have statistics here as well. You have a 3-day decline. We've had a couple 3-day declines that we can just point out here, but I can only see really a few instances of a 4-day decline. In fact, when I refer back to the actual statistics, I only have 2 other 4-day declines in all of 2013. All right, we have a number of 3-day plus, but 4-day declines plus, we've only had 2 in 2013, so that's highly unusual. How would I incorporate into that general picture? I'm looking at the S&P 500. Well, if I see this technical break, that's the first step. It's already confirmed. If I see the fundamental momentum from risk aversion, that's adding significantly to the picture. And if I go to a 4-day consecutive decline, it's statistically unusual. And if it's statistically unusual, we have fundamental momentum building, it is a grander probability, or a greater probability, that we actually have trend development. Now, we have to take into consideration things like the seasonality effect, which you talked about earlier, but it completes a more complete picture. All right. Now, I've also been looking at a few things for the FX market. I've been looking at, for instance, the series of higher lows on the yen crosses. Here's the dollar-yen. We've had a series of days where the low of the daily candle of the subsequent bars has been consistently higher. All right, for 9 consecutive days. This is the first time in 10 days where the low of the daily bar is lower than the previous days. All right, that is actually highly unusual. A series of 9 has not been met. It's only been met way back here in February of 2012. Before that, it was October 2011, and we haven't beat that trend, and we won't beat that trend because we do have that lower daily low way back here in March of 2011. Now you can see with each of these that there has been one instance of turn, second instance of turn. This one was a pullback, but not really a turn. You had a consistency here. All right, so it gives you a sense of what's happening. Now, with the dollar-yen, I keep the boxes that relate the 2012 to 2013 advance. That was the lead up to the Bank of Japan stimulus program and the follow through afterwards, because it can be a very similar fundamental picture for the dollar-yen as it was back then to what it is now. All right. That is a very big fundamental contingency here, and the technical aspects are also larger term. We have this big wedge break. Right? So a pullback, while it might have a good statistical probability, the level of pullback might be limited. All right, and I can look at that, and I can look at I can compare the statistical importance that I have here versus the fundamental theme, which is probably more important, and the bigger technical picture, which is less important than the fundamental, but more important than the statistics. Now, another yen cross that I was looking at that I think has a little bit more fundamental definition that might actually play in this particular pair's favor. You can see here that we had our first lower daily low on the euro-yen. You can see that we've actually tested a new lower low in 9 trading days. All right, this is highly unusual, as you can see, as it is exactly with the dollar-yen. And once again, a top, a stall, but not a turn. All right. Now we have a statistical importance. And we know that it's probably going to be lower because the same fundamental theme of the Bank of Japan is going to play in here. All right, but there is something of offsetting interest in the ECB rate decision that we have on Thursday. If the ECB were to note or actually adopt a new stimulus program, similar to what the LTRO was, then you have another element that you can see the euro drop off. Now, of course, risk aversion can play a big role here and just topple the euro-yen all on its own. But for now, we can look at that as a more definable and uncertain piece of event risk. In the last major FX statistical theme I was looking at here, and this is once again a higher low series on the pound dollar. Now it's only 6 consecutive higher daily lows. All right, we've had a number of these in the past couple of years. However, as you can see, more often than not, actually only one instance in this entire set where you haven't had a meaningful reversal or correction in price after a 6-day plus consecutive rally. And that only shows up right here. All right. So this one has yet to make a new lower low. And we have had a very remarkable run. We've actually tentatively broken this technical level, but follow through is very difficult to sustain because the fundamental aspects here are somewhat mature. This is not a risk-based currency pair, though in strong risk aversion themes, the US dollar will probably gain a little bit more traction than the pound. The Bank of England rate decision is coming up on Thursday, yet it's not likely to change. We do have the non-farm payrolls on Friday, which will tap into taper speculation, but we know that there is mature expectations for the interest rate forecast for the UK, and there's somewhat underappreciated market expectations for the possibility of an earlier taper than March. So you add the fundamentals and the technicals to statistical measures. Right? The quantitative field is certainly another tool that we can add to our bag of trading strategy, but you have to put the entire thing together. You can't have one aspect all by itself, or you're working with lower probabilities, and you don't want that. Right? So hopefully this clarifies and perhaps introduces you to a new field of trading opportunity. Go trading out there, guys. We'll do another Forex strategy video tomorrow.